those of you that don't know me, I'm Geoff Stuhr. A lot of you guys do. I see a lot of familiar faces. I haven't been in Milwaukee in a while. And it feels good to be back. It's nostalgic, and it feels good to be in the office here. I haven't even been here. Like, the twinkle lights are new to me, so that's been a while. It's a good addition. I helped start this meetup group with Brock and Adam. It was a lot of fun doing it. I hope to be here a lot more. So those of you that want to start coming back, who's all been here before? All right, it's a lot of new faces. Good stuff. Good stuff. I met a couple of you. Cool. Well, so this, we were kind of racking our brains. We've done a lot of different presenters, people talking about how to property management. Brian talking lenders, appraisers, everybody, CPAs, attorneys, everybody, that touches different aspects of real estate investing. And so we kind of thought, well, what else could we talk about? How to analyze the deal. Brock did. That was a great one. Watch that online. And so, a lot of times in real estate investing, there's someone that has the deal, that can find the deal, that can get access somehow, find a nice deal and analyze it. And there's people that have the capital, right? And it's tough to have both. When you do that, it's really nice. That's an ideal situation. But even then, a lot of times you want to partner with other people that have different skill sets and that bring different things to the table. So the talk today isn't necessarily just about like commercial real estate syndications or private equity real estate, but I'll touch on that too. But it's also going to be just if you've got if either you have cash and you want to do a deal with someone like a joint venture and you guys just partner on a deal and take it down, whether that's a flip or a smaller kind of buy and hold duplex, right? Like we'll touch on that too. So, and also I'm not too formal at all. I'm not going to eat pizza up here, but I probably will take a couple sips of the White Claw. So don't hesitate to ask questions, raise your hand. And it's not super in depth either. But. All right. So from an agenda standpoint, I'm going to just basically introduce what we're doing at Smart Asset Capital. To talk about, kind of before you start seeking money for deals, if you can find deals. I think this guy's looking for money. I already heard. I saw he came in hot.
Does anybody have any?
Yeah.
I'm serious.
Bitcoin.
All right. Yeah. Diamond hands. So, kind of the roles of someone that can find a deal and someone that can provide the capital. Investor avatars, like where do you find investors and what do you want to be looking for if you're someone that's got deals and you got deal flow, like how do I find the investor type of people that that I can partner with. Deal structures, talk about private loans, equity, different systems and processes. Then we'll go into syndications. Shit, I saw a typo on there. Sorry about that. 506B versus 506C. And then I've got some resources at the end, different books and podcasts and things like that. And also I'm not anything near an attorney, so don't hold me to any of this or anything like that. Disclaimer, not an attorney. Okay, so what is Smart Asset Capital? Adam was investing in real estate. It's been a while now, 10 years maybe, but 8, whatever, right? And I started doing some deals on my own, smaller deals. Adam helped me as an agent, and then I got my license, and then I was managing a couple properties, a few properties, and then decided I wanted to do that. Got him over here at the management company. And then as time went on, I started thinking, there's people that wanted to partner with me on deals. There's people, I know Adam has a lot of investors in his network, and, we kind of put our heads together and thought, we could kind of create a company or a model that people could invest in, without, without actually, needing to own the deal themselves and go get the insurance and go get the loan. And then, it's kind of a even more hands-off step than just the management company, like just buying your own, fourplex and having the management company run it, right? And so it was just kind of a nice evolution of Smart Asset, the brokerage and the management company. And what it is a private equity real estate syndication firm. We started in 2019. We met Brock. He was a solid addition to the squad, having a lot of fun with him. And he fits Adam and I are a little bit more of the back of the napkin math type of guys. Brock built his own analyzer with a spreadsheet, everything's big into Microsoft Excel. So you talk to him about pivot tables and all that stuff, not me. But so since then we've raised, $3 million. We've got, these aren't huge astronomical numbers. We're still definitely in the early stages, but we've got a nice little foundation built. 53 individual limited partners have made 82 total investments across 7 deals. We've got apartment units. We just got a self-storage, dipped our toes in self-storage a few months ago, which is going really well, by the way. Industrial, office, and retail. And this was called Wisconsin Apartment Investors Meetup. That was kind of our focus, but we just like good deals. So we're going to go where the cash flow is. But anyway, so to get into the meat here, what I would say before you start raising money, and this is just one guy's perspective too, so if anyone, is there any lawyers out here? Because someone's probably going to call me out on shit. But so anyways, what I would do is get educated. I would, learn about, I tell people to learn about investing in general, not just real estate investing, because you got to be able to compare it to the cryptos of the world, right? And just any other, different types of investing, whether you're in the market or bonds, whatever, right? You got to understand general investing before you can talk to other investors about investing in real estate deals. And then I would start to educate myself on general real estate, different types of real estate investments, whether that's different asset classes, like I was talking about, self-storage, apartment buildings, fix and flip, small deals like that. Get an understanding, ground up development, and start to get an understanding, a feel for what the different, different various asset classes and areas of real estate, what type of returns they can provide. Short-term rentals, each of them have different models, different kind of cash flow returns, different equity multiples. So start to familiarize yourself with that, and then analyze the market that you kind of want to focus on, or the markets. So if you live in an area that there's good cash flowing rentals, for those of you that live in southeastern Wisconsin, I've been spending a lot of time on the West Coast, and let me tell you, they think a 5 cap is the best deal ever. So we're in a good market here. So learn as much as you can about it, about the specific areas. There's differences even as you go more micro than southeastern Wisconsin. There's differences between West Dallas and Waukesha, right? Both are great markets, but they have different fundamentals. Maybe a little bit higher cash flow, a little bit more appreciation, sort of thing. You guys laughing out there?
West Dallas guys.
Hey, we love West Dallas too. And then start to formulate and develop a strategy and a business plan of what your focus is going to be. Where do you want to focus? Where do you want to spend your time? Where do you want to kind of be an expert? And then you can kind of branch out from there and start to develop a track record. And to develop a track record, I always tell people to start buying properties on their own if they can. Spend some time managing them on their own. I think at the most I only managed 6 or 8 units, but I have enough horror stories that I was like, Adam and Brian, they can do this a lot better than me, and it's a lot better money spent there. And I would tell anyone that as you progress, right, being a property manager, unless you want to build a property management business, that's a tough business to be in. They do a great job. So, that's a great way to start. Another great way to start is just participating as the cash in a deal, what we're talking about right now. Find somebody that's doing deals. There's always people that are looking, for capital to help with their deals. Come talk to me if you want to find them. Not that I'm pitching anyone here, just disclaimer, right? Just find someone in a joint venture, right? Whether it's, I think the first time my dad invested with me, he invested, we bought a duplex together, and then we bought another one, and then, then him and Adam and I bought a 30-some unit property in Racine that's killing it. And, now, we're just kind of, he's kind of maturing through the investor curve, right? He's going to get into syndications. Start to, as you develop a track record, then build out your network and your team. Are you going to be the guy that, it depends, how big you want to go. Are you going to be the guy that does all the management yourself? Are you going to be the asset manager and the property manager and the maintenance people and everything, right? And, probably not, right? Depends how big you want to go, but the best thing you can do is start to build out a network of people that can help you and be in your team. That also includes attorneys, CPAs, lenders, inspectors, and on down the list. And then as you build your portfolio of investments, even if that's as a passive investor, you can build like a credibility book. I'm in a group, Jake and Gino, for those of you guys know, and there's a few of you in here, I think, but wheelbarrow profits is what they're called. And they always talk about having kind of newbies or people that are just getting into building out a credibility book. And that's something that you can have if you want to show other investors, like, here's the deals I've been involved in, here's the decisions that I've made, and here's how the deal's panning out. And here's my role in that deal. And maybe it's just the fact that I analyzed a good deal sponsor and a good deal. So a credibility book or a resume, that's something that you can have, whether you actually want to write it down on paper or whether you have it in your head and you can, just talk through it, eloquently when you meet with people. So talking about roles,
Are you done?
there's a guy named Matt Faircloth that I've read his book. He's on Bigger Pockets quite a bit. He talks about the deal provider and the cash provider. He started out flipping deals, and now he's scaled his all the way up to syndication. So the deal provider, right, is somebody that usually has time on their hands. They've got knowledge. They've built up that credibility. Are we missing it? Because I can slow down. No. They're usually networking a lot. They're meeting with different brokers. Brock and I met 3 of them today. Across different firms, and they're meeting with banks, they're meeting with wholesalers, they've got connections, right? And they're consistent. This third one is the key point. I think if anyone that wants to raise capital for their deals, if you could consistently offer opportunities for others to invest capital in, you're going to eventually attract more capital, right? It's just finding those good opportunities for people to invest with you and then providing that as an opportunity. That's kind of the way we look at it, right? Like, we're not trying to sell anyone on a deal. It's just, hey, here's an opportunity if you want to invest in real estate. Simple as that. And here's what we know, here's what we've done before. Then they manage the deal, they can get shit done when things get tough. We've got a couple tough situations that we're working through right now, but we got a lot of great things going on. I think as you build a big portfolio, anyone in here that owns a lot of real estate knows that there's usually shit going on at least, one property a month, and sometimes more than one. I said under promises and over delivers. That's a big key. Cash providers, and this the way I was looking at this is like, down the list of who you could look to that could provide cash for your deal. So seasoned, I would say the best are seasoned and savvy real estate investors that want to be hands off, but they've already seen the power of real estate. They've already had some big scores, and they just don't really want to deal with it, right? So if you can be the guy that comes in and says, hey, I'm competent at what I'm doing, I can find a good deal, this is the deal. You don't have to like sell them on the power of real estate investing, and you don't have to like educate them up the learning curve. Secondly, would be high net worth individuals that are liquid, have a lot of cash, or high income earners. Typically, high income earners are, they're busy as hell, and they don't have the time to go out and go source these deals and find all this stuff, and they don't want to. People that have just had an inheritance or a recent windfall cash, maybe IPO or something like that. Either one, those are kind of like, hey, ding, ding, ding. Maybe talk to that guy. People that would have a lot of capital in their IRAs, and you can teach them around how to self-direct their IRAs. We had a guy come in and talk about that. I'm still trying to figure it out, but I know there's a lot of opportunity there. So anyone that wants to be an expert on that and take that one off, come talk to me. And then people in your network that have significant equity in their homes. People that bought their homes, 2011, 2012, depending where it is, but either way, they probably saw a lot of capital. Maybe they would be interested in doing a deal with you and, leveraging their home a little bit. Those are some ways to think about that. So there's a guy, Richard Wilson, I talked about him in the end of here, about thinking about investor avatars. So like, where can I find these investors? And what do they look like? And how can I get systems and processes around meeting with more of them? So like your profession, right? Are you, are you transitioning? Are you in a profession that, there's sometimes you meet doctors, lawyers, or you work with doctors a lot. Those people are great investors. And so that's one way to meet a lot of them. And you already probably built credibility and trust with them if you do your job well. Hobbies, if you like to golf, play tennis, or ski, things like that. Those are ones that typically you might find people on the golf course. I think Brock's out there every day these days. Adam too. Those are my partners. That's a good place to meet people that might have capital. Networking events. This is the other one. Come to a lot of them. Start them. You'll meet a lot of people. We've met a lot of people at these networking events that have invested and been great partners and are seeing great returns and are really happy with us. And then just your current network, family, friends, your high school friends. I got a lot of savers in the Franklin Savers. Those savers in a crowd. College buddies too. I just came from a bachelor party up, Wisconsin Rapids, and I had a lot of guys talking to me about what we're doing, and so we just got to get a deal for them to talk about this. It's kind of starting to happen.
That's the best time.
Is that what you're trying with the drunk?
Yeah, I mean, at the turn, and this is in between 18 holes too. So just in between our 2 rounds of golf, great time to start pitching. I say that a little tongue in cheek, but really, you know what? When people find out that you're in real estate, if you're having some wins, they want to know more about it. A lot of times, if they know you and trust you, they want to get involved. So deal structures. We're talking about private. You can look for private debt, private loans, or people that have equity in your projects. And so as far as private loans, typically it's a high interest rate, 10, 15% more sometimes. That's obviously best for short-term deals, flips, deals that have a ton of. If you can find a deal that has just a ton of great cash flow, and you need to make some renovations on it, and you need a short-term kind of hard money loan, private money loan, that's what you can look for that. They usually charge points and fees up front, or if you need to renew it, sometimes they'll limit how much of the loan that you'll have access to, until you perform a little bit. A lot of times it's collateralized, personally guaranteed. You can get interest only for a while on these loans, and this could be from banks, or it could be from a wealthy guy that has a lot of money that wants to get a high interest rate. There's a book called Lifestyle Investor by Justin Donald. He prefers investing in in like private debt deals, and then he just negotiates kind of a little equity kicker on the top end. So you could try to negotiate, hey, I'm not going to give you 10%, but I'll give you 8%, and then a little equity kicker, and I'll give you your money back once I complete my renovation or whatever project, and I get access to some more capital. Maybe go to a bank with a lower interest rate and kind of refi it. Any questions? I feel like I'm going fast, but I'm trying to help Adam get out of here. Thought we'd have more. All right. Deal structures for private equity, best for more strategic partners that are kind of aligned on interest the whole way. They want to see the project succeed, right? They want to get cash flow probably through the deal and then get the upside at the end when you sell, right? They want to be in it for the long haul. They want to have tax benefits. These types of deals are just more so turnkey rentals, joint venture deals, and then syndications, kind of like what we do. Some of the things to think about with these, you get preferred returns, and I'll talk about this a little bit more. If you invest in some of these private equity deals, there can be waterfalls. A preferred return is like you get paid 8% cash on your money before the deal sponsor gets paid anything, right? And so you're getting a nice solid return. You're still getting equity upside in the deal, and then you're kind of aligned with them that they have to perform before they get paid at all. Waterfalls are as the people that are putting the deal together, for everyone in the crowd here, that's what you're doing is you put the deal together. You can structure it as such where you switch it from once I pay a 10% return out, now I move it to, instead of 80-20, I can go to 50-50. And once I give them a 15% return, and now it goes to 80-20 in my favor. Those are kind of waterfall structures. Fees for private equity, deal sponsors will get acquisition fees. Very common to see 1 to 5%. 2% is probably the most common of an acquisition fee of the total deal. Asset management fees, and sometimes transaction fees and disposition fees if you're refinancing. And that makes sense, right? As you'll see, I'll talk to you a little bit more, but they're, the people that are putting the deals together, you can and should get paid for some upfront work and then align interests after that to make sure that, the property performs before you get paid in that way. And then we'll talk a little bit more about accredited and sophisticated investors later on. So some of systems and processes, this is another thing Brock's great at, not only analyzing deals, but a database. Having and maintaining a clean database. You can do that with CRM software like HubSpot. Social media processes, Laura Barzak's the one to talk to about that. She's great in the back there. Consistently posting on social media about what you're doing, or having a virtual assistant do it for you. Or you could use systems like Buffer that kind of like tie all your social medias together, and then post, you hit each channel, each one. The more that you post on there, if you're posting good, relevant content consistently, you're going to have people in your network. You're going to have people that share it, that just kind of pop up and start talking like, hey, I didn't know you. There's more people out there looking for deals than you'd ever thought of. Thought leadership, start a podcast or get on podcasts, or do blogging and get on guest blogs. All this stuff takes a lot of time, so it's certainly an art. Working a referral channel, both professional and personal. So if you've got that personal network that you've built out, that know what you do, then it's kind of, hey, can you help me tell your buddies about this? If you're investing and you're, happy with your returns, we're always looking for more investors. So kind of working that channel. Also professional network, like your CPA, your attorney, right? Those people know people that have money. And so the more that you talk to them about what you're doing, and just let them know, hey, we've got a deal. I've got a deal. I'm looking for, people that might want to participate. Could you make an introduction? As I said before, if you put together a track record document, I think Brock even brought one here about us. And then I put on here crowdfunding, private equity funds, and equity brokers. And that's some of the, as you get more sophisticated and higher level people, you can partner with people that are like literally brokers of like, they'll bring equity to your deal and they'll take, points or equity in the deal as well and kind of get on the GP of the overall deal. But networking is key. All right, so what's a syndication? Who's all familiar with syndications here? We got a lot of them. All right, essentially just, kind of partnering together, combining skills and resources with people to essentially, a lot of times buy properties that, an individual is not necessarily going to buy on their own. And that can be even people that have a shitload of money, right? If you've never bought or managed real estate before, it's probably going to be tough for you to get a loan, even if you're like, hey, I got the down payment, but it depends who your lender is, but a lot of times they're going to be like, well, I don't know if you, say we looked at a $40 million deal today, kind of for shits and giggles, but we might, who knows, someday. But even if a guy came in that owned no real estate and said, hey, I got $10 million, I could stroke the down payment. Is the seller going to believe that he can, manage the deal? Is he going to get a loan for $30 million that he's never managed a property before? So it makes sense to kind of partner with people on that angle. And a syndication is the ultimate form of the deal provider and the capital providers. So essentially, you'll have deal sponsors, GPs and KPs that can source the deal, negotiate the deal, go negotiate the lending, try to get the best terms on your financing, close on the deal, and then operate and manage the deal and manage the assets so that you make sure that your investors are getting that return. And then the limited partners are essentially providing the capital and saying, hey, you know what? I think I'd like to be involved in real estate. I'd like to get the tax benefits of depreciation involved with real estate. I'd like to have the cash flow. I can stomach having my money tied up for a little bit. I don't know what the stock market's going to do. I don't know. I got paper hands. I'm in crypto and I don't want to be in that anymore. I hedge my bet against inflation a little bit, and I want to be in real estate. And so that's a syndication in a nutshell. That one's wordy. That was the one I put together at midnight last night, so there might be typos on that. I found a nice little chart. If you're doing syndications and raising private capital, this is 506B, rules 506B, rule 506C, the regulations or whatnot. So I was asking if there's any attorneys in here that probably call me out. This isn't necessarily if you're just like, hey, I found a deal. It's a single family home over here or a duplex and I want to find some capital for it. You probably don't need to worry about that. You're really looking at friends and family and kind of network connections. Disclaimer, I'm not an attorney, so don't come after me for saying that. But basically what 506B is that it's open to any accredited investor and up to 35 sophisticated investors. And sophisticated investors kind of like a gray area where a accredited investor is it's a lot more black and white. Sophisticated is like you would have to have reasonable expectation that they can, evaluate the investment opportunity for themselves. And with 506B, you've got to have some touch points like beforehand. Like if we had a deal under contract right now and we were doing a 506B and I was just totally pitching it to you guys, like the next slide was the deal offering. Then I'd be violating that. I can't do that. But if it was 506C and I said, hey, who's an accredited investor here? Woo woo! There's my girl. Then I could say, hey, come talk to me about this deal afterwards, right? You can openly solicit a deal under 506C, under Rule 506C. To be an accredited investor, you got to have an annual income exceeding $200,000 for individual, $300,000 for joint income for the last 2 years, an expectation of earning the same or higher in the current year, or have a net worth exceeding $1 million, excluding your primary residence. And by the way, the reason I put all this stuff on there too is I can send this to anyone who wants it afterwards. I'm getting towards the end here. Oh, actually, I think I am at the end. Here's some like resources if you're looking to go out and raise capital for your deals. These are some of the best books I've found. There's like this familyoffices.com. When you get really sophisticated and you're doing big deals, they have a club, like you can go to a lot of their meetups, and they are literally trying to marry up high net worth individuals and family office with deal providers, right? So once you get highly scrutinized there, but once you can get to that level, and you do have to pay to be a part of the club, but once you can get to that level, there's the capital's unlimited. It's more just about selling your track record and your deal. And then Search Funder is a new one that I found kind of interesting on there. There's real estate private equity money out there. And then Bigger Pockets, obviously everyone knows that. There's a lot of people on there that if you start, posting on there, I met a great partner on there in Brock, but I haven't met investors. Have we met any investors on there? Yeah, we have. So if you post it up on there and you know what you're talking about, you might meet some people that can invest in your deals. And that's about it. Any questions, comments?
At what point do you decide to do like a joint venture versus a 506B? Is it like a capital issue, or say you get like 4, 5, 6 partners? Is it like an amount of people, or how do you really determine the trust to fund the deal?
All this stuff is like subject to, how you structure a deal, what the returns are, what the equity amounts are, is all subject to your own negotiation, your own, ideas. So it really just depends. If you are a little bit more sophisticated and you want to kind of build a company out of it, then I'd say, you go the syndication route. If you don't have a track record, if you don't, and then you go approach people, they might say, well, I want to be part of the GP. So typically the general partner will get, 20%, 30%, 40% of the upside of the deal. And sometimes people with a lot of capital that are really savvy real estate people will say, no, I don't want to do that. I'll provide capital, but I want to be, I want to be a straight partner. And, so it's kind of up to your discretion and up to what you can sell to other investors. And so a lot of investors are like, but I would say if it's a joint venture, then you're also kind of putting more risk on them. Are they personally guaranteeing the loan? Are they, are they doing any of the work, or are they just literally providing the capital and expecting you to do everything? If they're going to do some of the work and they find the deal, personally guarantee the loan, help negotiate the deal, help negotiate the terms of the loan, manage the asset, make sure that it's, or do they just want to, get passive income every month or quarter? That's how I would determine it.
So this might be getting a little in the weeds, but for the deals that you guys are working on, that scale of deal, that size of deal, what's the cost, your upfront hard cost total? Setting up the contracts, doing the due diligence. How much are you guys putting in before even sending out?
That's a good point. So when we get a deal under contract, we're putting earnest money down, right? Like $25,000, $50,000, right? It's leaving our bank account. We're getting the lawyers started on deal fees, right? So and some of that stuff you can't recoup, and that earnest money potentially can go hard. And I know people that have lost 50 grand in a deal. Bill Ham, I think he spoke here once, maybe, but he was in here. But so that's a lot. That's a big portion of the syndication versus joint venture. Like if it's a syndication, the deal sponsors are putting up a lot of that upfront money. I don't know. Each deal is a little bit different, right? I mean, and you try to time it as a deal sponsor. You try to make sure that your money is going to be as safe as possible, and that you're not going to lose it. So you try to start to raise money right away to help kind of offset that stuff, or to feel more confident in letting your money go out the window.
What are your average, what's your average investment?
Yeah, put that in the front slide. I was looking it up on Syndication Pro, which is our software that we're using. It's kind of like Appfolio, but for the syndication asset management side. And that's where we can direct deposit out our distributions right directly into our investors' bank accounts. It said 30,000 was the average investment.
Yep.
You know, we did some deals where I think when we were getting started, we had like 8,000 or 9,000 was the
So
minimum.
this is really obtainable, because these are modest numbers, these are obtainable.
Yeah. I mean, we're trying to scale it up and get to the point where, you know, we can have a $50,000 minimum or a $100,000 minimum, but right, like I said, we're not way, you know, way up there in the syndication firm, I would say, right? It's got a long ways to go, but 30,000, hopefully we'll be at 50,000 pretty soon. But we've got investors that have invested 150,000 or more into the deals.
So I was going to ask, to try and secure capital, what kind of rates do you think you need to offer to be able to secure that? Like what kind of preferred returns do you think at the moment?
Yeah. Well, and you don't even have to do preferred returns either. You could just say, hey, look, we're just going to make it cleaner, more simple, and just do straight partnership. You know, you guys get 80%, we'll get 20, or you know, whatever, 70-30. The preferred returns that I've seen have ticked down. You know, 7%. 7% cash flow, 8% cash flow, cash on cash return. Especially if you've got a good like value add plan and strategy where you can improve the property and you can understand, hey, there's a path of progress here, and we think we're really going to be able to sell it for a lot more down the road. So maybe you only take a six pref, 6% preferred return. You're still making money. You know, maybe it's not exactly what you can make in the stock market over the long haul, but that would be with maybe a 20% internal rate of return, right, or annualized return. And that's kind of a higher level calculation. But if you can say, hey, you're getting the tax benefits, a lot of times because of the depreciation of that building, that cash flow, you're not getting taxed on it like it's earned income, like it's income from a job. So 6 to 8%, 8% pref, I think you can get a lot of people interested.
Can you talk a little bit about how, I think, one of the deals that you guys have done, and then talk about how depreciation works across your various investors? Is it just a split? Is it a percentage base?
Yeah. Well, so that depreciation passes on to the investors. Like it's not like a paper stock, right? They're partners in the deal, so their amount of shares, like the amount that they've invested, that split is equal to how much depreciation is passed on to them. I'm probably not the best one to talk about depreciation and that whole thing, but I definitely know. We do cost segregation studies, and I don't know, Brock, maybe you could help me out on one of the deals that we've done that we passed a shitload of depreciation on to the investors.
Yeah, I mean, one that there's $400,000 depreciation a year. It just passes through someone 10% of the shares, they get 10% of the depreciation, and so on amongst all the investors, and carries on for years. It's not all used in year one.
So I make sure asking my CPA or questions.
Yeah, I mean, so you get a K1 statement at the end of the year, and it's all laid out in the depreciation income. So that part's not too big a document.
We've got a great real estate accountant at Bull Moose. I think they've spoke here too. And her name's Megan. She's great. They got a bar in their office, so that's cool too. It's in the third ward. And I just trust her that she's doing the right thing. And I see numbers like that, 400,000, and they're off. I'm like, absolutely. I should probably learn a little bit more about that too. I do get asked that by investors a decent amount. That's why I have great partners too.
So I have kind of a mechanical question. You guys are taping this. Is this going to be available?
Yeah, recording. Yeah.
Yep, I'm gonna send it out to everyone online.
And I'm happy to send the PDF out too to whoever. So I've got I've got the Smart Asset Realty email and the Smart Asset Capital email, and it's just Geoff with a G. I probably should put that at the end here. So GEOFF, like the draft. At Smart Asset Capital, I'll send it to you.
Are you seeing a tightening in the ability to get capital, or are you seeing that things are becoming easier?
No. There's a lot of capital out there. What it is you got to find a deal.
Yeah.
That's the hard part to find. Deals, property owners right now they're holding all the cards. So that's the hard part's finding a deal. If you find a deal, you can find the money.
Are you concentrating in Wisconsin or?
Yeah, right now we're only in southeastern Wisconsin. We've talked about expanding to different markets, maybe the southeast. I think that's a long-term play. We want to build this into a big company and help the management company then grow too. And
Have
in
you done
the
anything
broker.
out of Wisconsin?
What's up?
Have you done anything out of Wisconsin yet?
I haven't, no. But I've looked a lot in Reno, Nevada. That was a market I thought was kind of, the thing is, like, some of these big markets outside Wisconsin, Orlando, Tampa, Austin, Dallas, Houston, Phoenix. I mean, they're just kind of really been tapped.
It's awful.
Yeah, so that's the thing. I mean, Wisconsin and Ohio, those are great markets for steady, stable cash flow. Not going to see a lot of swings up and down. And so then you juggle, like, hey, do we want to be the expert in one area or not? But since I was, spending some time out there and renting a house out there, I went and met all the players, and I went and looked at deals. And the thing about it is here, we just know so many more people. So we can get access to, to more deals better. And kind of learn about them before they're on the market. Like to me, out in Reno, where they're seeing huge population growth, people moving away from California, selling their houses into a better tax area. It's just I'm not in the in group there, and so the deals they haven't made sense. But it's also what type of deal too. I mean, I do think you could do. There's a term called BRRRR. When you buy it, you rehab it, then you rent it out, and then you refinance it, and then you can kind of have infinite capital in the deal, get your money back, and still own it, even if it's only cash flowing $200 or $300 or $100 a month. I think there's an opportunity for that out there. I don't know how long I'm going to stay out there. If I could have found some big nice deals out there, maybe we would have expanded out there and looked at it, but I haven't. All right, are you guys we good, or I'll be here for a while longer too. I'm good if you guys are.